That crash in silver wasn't the market changing its mind. It was leverage getting put through a paper shredder on purpose into year-end thin liquidity so the strongest hands could buy what the weakest hands were forced to dump. And if you stay with me, you'll know exactly what levels matter next, what signal confirms the trap, what breaks the setup, and why the next week or two can get even more violent than the drop you just watched. Because here's the part most people miss. In a market like silver, the headline doesn't set the price in the short run. The collateral math does. The exchange tweaks margins, the brokers tighten risk, vol spikes, and suddenly the same position that was fine yesterday becomes a margin call today. Not because the thesis changed, not because industrial demand vanished overnight, not because the world suddenly found a mountain of new metal. It's because your paper exposure just got more expensive to carry, right when liquidity is at its worst and the calendar is forcing books to close, and that's where the real pressure starts. Let's pin down what just happened in plain terms without fairy tales. Silver ripped into year-end on a historic run. It spent 2025 behaving like a small market being discovered all at once, with prices pushing into record territory and volatility that looks more like a crowded tech momentum trade than a boring metal. Then, right as it tagged the obvious psychological zone, the kind of level every retail chart is staring at, the trapdoor opened. A margin hike hits, volatility flares, and the market does what it always does when the cost of leverage jumps. It forces selling from the people who can't afford to stay in. That is not a conspiracy. That is how a futures market survives when volatility explodes. Raise collateral, reduce systemic risk, flush leverage, clean the pipes. But the consequence is always the same. You get a mechanically induced liquidation wave that looks like a fundamental reversal, right until the forced sellers finish. And that's not the part that matters. What matters is what happened after the flush. Silver didn't just wobble, it snapped back hard. A move like that, a sharp dump followed by a sharp reclaim, is almost never random. It's the fingerprint of positioning getting reset. It's the sound of stops being harvested and shorts getting bowled at the exact wrong moment. It's the moment where the market tests whether the move was real and then punishes anyone who traded the headline instead of the mechanism. So let's talk about the fake crash the way pros do, as a sequence of forced decisions. In a leveraged market, nobody sells because they want to. They sell because they have to. Margin goes up, volatility goes up, and your broker calls you for more collateral. If you don't have it, you liquidate. If you do have it, you choose. You either feed the position with more capital or you reduce size. And when a whole crowd is making that decision at the same time, into thin liquidity near year-end after a historic run, price discovery gets warped. That's why you see those vertical red candles that feel evil. It's not evil, it's forced selling meeting empty order books. Liquidity thins, spreads widen, and the market moves farther than your brain thinks is reasonable. And then, when the forced selling is done, the same thin liquidity works in reverse. Bids reappear, shorts scramble, and you get that violent green snap that makes people feel like the market is mocking them. Because it is. Now, you want proof, not vibes, not narratives. Proof that this was a mechanical flush, not a sudden collapse of the bull case. Start with the calendar. This is year-end. That matters more than people admit. Funds don't want weird, illiquid, high-vol exposures sitting on the books as they mark performance. Risk managers don't want tail events on the last days of the year. Dealers are running thinner, market makers widen out. And when you combine that with a margin hike, or even the anticipation of tougher collateral rules, you create the perfect environment for a one-day air pocket. That's the first layer. The second layer is the exchange itself. When an exchange increases margin requirements, it changes the effective leverage of every participant. The same contract now requires more capital. Levered longs are forced to de-risk. That selling pressure is not bearish sentiment. It's a spreadsheet, and the spreadsheet doesn't care what you believe. But the next detail flips the whole setup. If the sell-off is mostly forced, it tends to be fast, ugly, and self-limiting. Because once the weak hands are cleared, there's nobody left to dump at any price. That's when you watch for the rebound behavior. Does price reclaim key zones quickly, or does it grind lower and fail on every bounce? A sharp reclaim is the market telling you the flush did its job. Now layer 3, positioning and reflexivity. Silver is small, that's the entire game. It doesn't take everyone to move it. It takes a marginal wave of flows into a market with limited depth. And once it starts moving, it pulls more flows in, because performance chasers chase, trend systems add, and the story gets louder. That's reflexivity. The move creates the conditions for more move. But reflexivity has a dark side. When volatility spikes, those same systems are forced to cut risk. CTAs reduce exposure. Vol targeting funds sell. Dealers hedge differently. And suddenly you get a cascade in the opposite direction. And that's where the trap is set. Right when the crowd decides the top is in, The market shifts from liquidation to re-risking. Here's the mechanism explainer that matters most for the next week. Dealer hedging and option-related flows. When there's heavy options activity near major strikes, the round numbers, the obvious levels, dealers who sold options hedge their exposure by buying or selling futures. If price is rising and dealers are short calls, they may need to buy futures to hedge as delta increases. That's delta hedging. If price rises into a zone where call open interest is concentrated, hedging demand can accelerate. That's when the move stops being emotional and starts being mechanical. It's math. Now flip it. When price drops hard, that hedging demand can unwind. Dealers may sell futures as delta collapses. That can intensify the drop. But if price then rebounds through a key strike zone, hedging flows can reignite. You get a snapback that feels like a whiplash because it is, and if one level breaks, the math changes. So where does the fake crash fit in? It fits right into the dealer risk margin triangle. A margin hike forces liquidation. Liquidation spikes realized volatility. Higher realized volatility makes options more expensive, widens spreads, and triggers risk reductions. That reduction creates a vacuum. Then, when price stabilizes and reclaims a key zone, the same participants that were forced to sell are no longer selling, and the participants that sold short into the panic suddenly face a market with no easy liquidity to buy back. That's the trap. Now let S stack more proof, because no single argument is enough in a market this loud. One proof point is the sheer magnitude of the move in 2025. Silver didn't crawl higher. It exploded, and it did so while gold and other precious metals were also posting blockbuster gains. That matters because it tells you the regime is not silver-only hype. It's a broader precious metals bid, amplified by silver's small size and industrial sensitivity, but that's not the part that matters. Another proof point is rates expectations. Precious metals breathe when real yields soften and when investors start pricing an easier policy ahead. Into 2026, markets have been leaning toward additional rate cuts. You don't have to love the macro story. You just have to respect the flow consequence. Lower expected yields reduce the opportunity cost of holding non-yielding assets, and they invite allocation shifts. Third proof point, investor flows. Silver ETPs saw strong inflows during 2025, and reports citing industry data pointed to sizable net buying earlier in the year. That matters because it's not just leveraged futures money, it's longer duration money parked in products that don't get margin called the same way. When your market has both levered traders and steady allocation flows, you get the most explosive kind of volatility. Short-term forced moves on top of long-term accumulation. Fourth proof point, physical tightness signals. Here's one of the cleaner, less sensational facts from 2025. London Vault holdings of silver declined meaningfully during parts of the year, according to industry reporting. Even without obsessing over any single data set, the direction matters. When readily available stocks trend down, the market becomes more sensitive to delivery demand and logistical friction. That doesn't mean there's no silver. It means the buffer inventory that smooths shocks is thinner, and that's where the real pressure starts. Fifth proof point, the spread between paper urgency and physical availability shows up in borrowing costs and lease dynamics when things get tight. When the market is calm, nobody cares. When the market is stressed, anyone who needs metal now will pay up, and anyone who is short physical will scramble. You don't need to shout shortage to understand the incentive. If supply is not instantly flexible, and silver supply often isn't T, because a big portion is a byproduct of other mining, then demand shocks or policy frictions can be met quickly. That creates time-based stress, which shows up in forward pricing and financing. Now, let me give you the hidden detail, the one that reframes the entire story. The hidden detail is that the crash was not primarily a vote on silver OS value. It was a forced transfer of exposure from levered hands to better capitalized hands, engineered by collateral mechanics at the exact moment liquidity was weakest. Read that again. This wasn't the crowd suddenly deciding silver was worthless. This was the market forcing a reshuffle of who gets to hold risk into the next calendar window. And here was why that matters right now. If you misinterpret a collateral-driven flush as a fundamental reversal, you will repeatedly sell the lows and buy the highs. The market will train you to do it. It will use your emotions against you. It always does. So let's build the viewer psychology shield, because if you can't control your behavior, none of the mechanics matter. When silver goes vertical, the market plays two games on your nervous system. The first game is euphoria. It makes you feel late. It makes you feel like if you don't buy now, you'll miss the move of your life. It compresses your time horizon until you're trading your feelings instead of your plan. The second game is terror. It makes the pullback feel like the end of the world. It makes you imagine a total collapse. It makes you forget why you were bullish in the first place. It makes you react to a single candle as if it's a permanent regime change. But that's not the part that matters. What matters is recognizing the difference between trend signal and noise. Trend signal is structural. Higher lows over time, repeated reclaim of key zones, sustained demand in risk-on and risk-off moments, and flows that persist beyond a single session. Noise is the violent whip, margin call selling, stop runs, thin liquidity gaps, enforced dealer hedging. Silver right now is a market where the trend can be bullish and the noise can still punch you in the mouth. You can be right and still get wrecked by position sizing. That's why the only sane approach is to anchor to levels and scenarios, not feelings. So let's talk levels, not with fake precision, but with functional clarity. After a move that saw silver tag record highs above the low 80s and then flush into the low 70s, the market has drawn a bright line in the sand. The psychological $80 zone is no longer just a number, it's a battlefield. Above it, you invite the breakout crowd and the dealer hedging that can snowball. Below it, you invite the top callers and the risk managers who want volatility lower. And that's where the real pressure starts. The next key zone is the mid-70s area. Call it the region around $75, because that level was a headline milestone in late December, and it's the kind of place the market loves to retest. If price can hold that region on pullbacks and keep reclaiming it quickly after dips, it tells you the dip buyers are real, and the market is still in only buy the flush dominant mode. Below that, the low 70s becomes the next battlefield. Around $72, give or take, because that's where the market was sitting after the year-end turbulence. Lose that area and fail to reclaim it, and the market can slide into a deeper reset because the trapped late longs will start to panic and the fake crash can turn into a real liquidation wave. But if it holds, the entire story changes. Now, you're probably asking, why would the exchange raising margins not be bearish? Doesn't that mean the rally is over? Here's the honest answer. Raising margins doesn't kill a bull market. It changes its texture. It forces out the most levered participants. It makes the market more hostile to late, oversized bets. It increases churn, but if underlying flows and macro regime support remain, the bull trend can continue, just with sharper drawdowns and faster rebounds. It's exactly what a mature bull market looks like when it is entering the phase where it punishes complacency. And that's not the part that matters. The part that matters is who is forced to act next. Look at the calendar trigger coming up. We are stepping out of year-end and into a new month. New allocations, new risk budgets, new positioning. That transition matters because the end of year forced behaviors fade. The window dressing ends. The I don't want this on my books selling ends. And the market gets a fresh chance to express the real balance between demand and supply. At the same time, the margin regime doesn't vanish. The higher collateral remains a tax on leverage. That means the next leg up, if it comes, is more likely to be driven by stronger capital. And that can be even more dangerous for shorts because it's not as easily shaken out. Now let's address the biggest counterpoint head on, because if you can't survive the counterpoint, you can't trade the thesis. The counterpoint is simple. Silver is up an absurd amount. It's historically volatile. Parabolic moves don't last. The market can retrace hard, fast, and far, even if the long-term case is still intact. And the exchange raising margins is often associated with peaks, because it tends to happen when volatility is already extreme. That is all true. But here's the rebuttal mechanism. A peak is not just big up, big down. A peak is distribution, repeated failures to reclaim key zones, weaker rebounds, and a shift in behavior where rallies get sold faster than dips get bought. So the question is not, did it drop hard? The question is, did it regain control quickly, and does it keep doing that? Because if this one level breaks, the math changes. Now let's zoom out to the global angle, because silver isn't trading in a vacuum. It sits at the intersection of monetary fear and industrial demand. That's what makes it so explosive. Gold is more purely monetary. Copper is more purely industrial. Silver is the hybrid, and hybrids whip harder. In 2025, industrial metals were strong, with copper hitting records on demand narratives tied to AI infrastructure and energy transition. At the same time, precious metals surged on a cocktail of rate expectations, geopolitical stress, and central bank buying. Silver benefits from both worlds. That doesn't mean it goes up in a straight line. It means the bid can reappear quickly after mechanical sell-offs, because it has multiple constituencies. That's another layer of proof. Now here's where the market structure gets nasty. Paper versus physical. Most price discovery happens in paper markets. Futures, options, OTC swaps. Physical flows matter, but they matter through the stress they impose on paper when deliverable supply is constrained or when financing gets tight. When everyone is calm, paper can drift far from physical reality. When stress hits, physical constraints start vetoing the paper market. And that's where the real pressure starts. You don't need to claim there's no silver. You just need to understand delivery and logistics. If a manufacturer needs metal, they need it on a schedule. If refiners and shippers have lead times, they can't magically accelerate because price moved today. If policy changes add friction to exports, that friction shows up as delays, higher premiums, and a scramble for readily deliverable supply. And in a market this small, even a small amount of friction can move price disproportionately. Now, I'm going to be careful here because you demanded credibility. Policy headlines can be exaggerated and not every rumor becomes a constraint. But the market is paying attention to the idea that governments treat strategic materials differently when the world gets tense. Whether it's tariffs, export licensing, or strategic stockpiling, the key is the same. Friction matters more than bans. Bureaucratic control can tighten supply without an outright prohibition. It slows the pipe, it forces buyers to plan earlier, it moves demand forward in time. And when demand gets pulled forward, inventory stress accelerates. But that's not the part that matters. The part that matters is how that interacts with a leveraged paper market. Because even if the physical story is supportive, a margin-driven liquidation can still smash price temporarily. That's what you just watched. Physical doesn't stop liquidation. It only determines what happens after liquidation ends. Now, let's put the trap into one clean timeline so you can see it. First, silver runs into a headline level, volatility rises, and everyone starts watching the same numbers. Second, margin requirements rise, and risk managers tighten collateral needs. Third, levered longs are forced to de-risk into thin liquidity. That creates the crash. Fourth, the crash triggers short selling and panic. That creates fresh supply of shorts. Fifth, the forced selling exhausts. Price stabilizes, then it reclaims key levels. Sixth, shorts who pressed into the panic have to cover into a market with thin liquidity and a renewed bid. Seventh, the rebound becomes violent. Not because the market decided to be bullish, but because the short-term supply of sellers vanished and the short-term demand from covering and hedging surged. That is a trap. Now the next week matters because traps have aftershocks. The market doesn't just go back to normal. It searches for the next pocket of liquidity. And that's where the real pressure starts. So here's what to watch in real time without getting hypnotized by every tick. Watch how silver behaves around reclaimed levels. When price dips, does it snap back quickly? Or does it grind lower for hours and then fail on the rebound? Snapbacks tell you sellers are exhausted and buyers are defending. Grinds tell you distribution is taking over. Watch the speed of rebounds. In a healthy, aggressive market, rebounds are fast and ugly. In a topping market, rebounds are slow and polite. You want to see urgency on the bid. You want to see the market punish shorts quickly. Watch volatility. Not in the sense of high is bad. High volatility is normal in silver. What you watch is whether volatility is being used to liquidate longs repeatedly with weaker recoveries each time. If recoveries stay strong, volatility is a weapon, but it's not a death sentence. Watch the calendar. The first full week after year-end often brings a reality check. New money comes in, but so do new shorts who think this is too far. If silver holds key zones during that influx of skepticism, it tells you the trend is stronger than the disbelief. Now, let's talk about risk framing, because this is where trust is earned. Silver can whip around violently even if the thesis is correct. It can drop 5% in a day and still be in an uptrend. It can rally 5% in a day and still be fragile. That's the nature of a small market with leverage and options. If you size a position as if silver behaves like an index, you'll get emotionally hijacked. You'll make panic decisions at the worst possible times. You'll confuse noise with signal, so you need a two-scenario lens. Not predictions, scenarios. Scenario 1 is the controlled pullback and retest. Silver pulls back into a defended zone, chops, frustrates everyone, then grinds higher as the market digests the margin regime and the year-end reset. In that world, you see support hold in the low to mid-70s region, you see quick reclaim after dips, and you see breakouts that hold instead of instantly failing. Scenario 2 is the continuation squeeze and gap risk. Silver reclaims the key psychological level. Momentum ignites, shorts cover, dealer hedging adds, fuel, and price accelerates back toward the highs. In that world, pullbacks are shallow, rebounds are violent, and the market starts printing levels that make rational people uncomfortable. Both scenarios can happen with the same fundamentals. The difference is positioning and liquidity. And that's not the part that matters. The part that matters is what invalidates the thesis you're actually trading. If you start retrading the fake crash thesis, the idea that this was a forced flush and the trend remains intact, your invalidation is not it dipped again. Your invalidation is a behavioral shift, repeated failures to reclaim key zones, bounces that get sold hard, and a breakdown that holds below the low 70s area for more than a brief flush. If the market breaks down, fails to reclaim, and starts treating rallies as selling opportunities, the trap thesis weakens. It doesn't mean silver is dead forever. It means the market wants a deeper reset, and you respect it. If the market holds, reclaims, and keeps punishing shorts, the trap thesis strengthens. Now, I want to address one more uncomfortable truth. The media will frame this in a way that maximizes your emotional reaction. When silver is up, they will find a reason that makes you feel like you must buy now. When silver is down, they will find a reason that makes you feel like you must sell now. They will attach certainty to randomness and make you think you're missing a secret. Here is your shield. Stop consuming the story as entertainment and start consuming it as a mechanism. When you see margin hike, translate it to forced deleveraging risk. When you see big drop, translate it to liquidity vacuum plus stop run. When you see big rebound, translate it to short covering plus hedging flows plus exhausted sellers. When you see record highs, translate it to option strikes, dealer exposure, and crowded positioning. That is how you keep your nervous system out of your decision loop. Because if you don't, volatility will use you. Now, let's bring it home with the near-term roadmap, the one you can actually act on with a clear head. Over the next week or two, the market is going to test whether the bounce was just relief or whether it was a regime reassertion. If silver holds the mid-70s region on pullbacks and keeps reclaiming quickly, that's your confirmation that the trap worked and the trend is trying to continue. If silver reclaims and sustains trade above the big psychological level again, that's when the squeeze risk rises, because late shorts will be forced to cover and dealers may have to hedge into rising delta. That's when moves can far exceed anything expected, not because of magic, but because of forced buying. If silver loses the low 70s area and can't reclaim it, that is your warning that this wasn't just a margin flush. It is becoming a broader de-risking phase, and you respect the possibility of a deeper drawdown. And that's where the real pressure starts. One last thing before we close. None of this is a promise of profit. This is a map of how the machine behaves when volatility meets leverage meets calendar stress. If you treat it like a guarantee, you'll get punished. If you treat it like a framework, you'll get clarity. And if you're here because you're tired of being emotionally whipped by headlines, stay in this community mindset. Disciplined, mechanism first, risk aware. Not because it sounds nice, because it's the only way to survive a market like silver when it is trading like a meme stock with a refinery behind it. Watch the levels, watch the behavior, respect the calendar, size like an adult. And Donna T let a manufactured flush talk you out of the very signal it was designed to test.